Hey everyone, Eric Dutram here for Zacks.com, coming to you with the latest edition of the Dutram Report. Today we're going to be talking with Bryce Doty, Senior Portfolio Manager of Minneapolis-based CIT Investment Associates. We're going to be talking about the Federal Reserve, coming interest rate hikes, and their fund, the CIT Rising Rate ETF with the ticker symbol RISE. So stay tuned for that in a second. Bryce, thanks for joining me today.
Thank you.
And, first off, let's just kind of start talking about the Fed here. We just had the recent meeting, and, it was some of a split decision, though. So are we kind of edging towards a rate hike from the Fed this year?
I think we are. I think it finally might happen again. It was surprising to see the three members that dissented in favor of a 0.25% increase. There's a early November meeting that I doubt they'll do anything with it being so close to the election. But it does certainly set us up for a rate increase in December.
Yeah, and you know what? It seems like anytime we do get any indication that the Fed might hike rates, the market sort of sells off here. So maybe you can talk to us about, let's say the Fed does hike rates in that December meeting. What's going to be the impact on investor portfolios, and specifically in the fixed income portion of a portfolio?
Right. In the short end of the yield curve, you will likely see an increase in yield. The longer end, 30-year maturities, that sometimes those yields might actually decline when the Fed raises rates because they're more concerned about inflation risk. And if the Fed appears vigilant against inflation, that's positive for long investors. But for investors in 1 to 5 year type of maturity bond, you should see yields go up just like they did a year ago, December, when they raised rates. And that, of course, is negative for bondholders in that part of the curve because as yields go up, as you know, the price of those underlying bonds goes down.
Definitely. So might you say that the multi-decade bull market we've seen in bonds is sort of nearing an end, at least for the short end of the curve?
It does seem to be nearing the end. For the almost 10 years, we haven't really had inflation. We certainly have inflation today. The Fed has mentioned that it has risen. It's not totally at their target, but getting close. So I think that does act as the end of the bull market as we know it.
Okay. And so I know you guys have several mutual funds, but we'll sort of segue into your ETF that you have. The symbol's RISE. That's a great ticker, by the way, for a ETF. And so maybe you could tell me why you guys got into the ETF business in the first place.
Yeah.
Why the transition away from, not necessarily away from mutual funds, but
right.
Into the ETF space.
This fund, this ETF RISE, is patterned after a rising interest rate strategy we created for our large institutional clients about 4 years ago. And it was meant to be used in conjunction with their existing bond portfolios to protect them from the volatility we've seen in the bond market this year, and specifically is designed to actually make money when the Fed raises rates because unlike traditional bonds that will lose money when yields go up, RISE is shorting Treasury securities so that it actually makes money when yields rise. And so it's a perfect hedge for the current environment that we're in.
Yeah, maybe you can talk a little bit about how the fund actually goes about, shorting the product to sort of get this positive situation when interest rates rise. Or futures, options? Is it a combination of both?
Yeah. No, it is. We're shorting the futures contracts on 2 and 5 year maturity treasuries for the most part. We do have a put option on the 10-year treasury, but most of the price sensitivity of the fund will go in the opposite direction of the 2 and 5 year treasuries. And when I think of shorting a futures contract, I think of it as borrowing something from your neighbor, saying, I'll get that back to you in 3 months. In the meantime, you've taken what you've borrowed and you've sold it to someone, hoping that you're going to buy that back before you have to give it back to your neighbor at a lower price. So in this case, you would sell a bond at $100, hoping that you're going to buy it back after interest rates rise at a price of only $95, and you pocket that $5 profit. So that's how I think of shorting, and that's exactly what this fund is doing in order to get to what we term a negative 10-year duration, meaning that if rates go up by 1 percentage point, the fund will make almost 10% in price appreciation. That's the target of what it's supposed to do. So if you have a bond portfolio, you can just add a little bit of rise, and it should cushion a lot of the volatility. In fact, on our website, right in the home page, is a little very quick calculator that you can use to see what the effect will be. If you just add like 10% of your bond portfolio into rise, it could cut your interest rate risk by a third, and that's at risingrateetf.com.
Yeah, and maybe you can talk about why you guys picked that negative 10% or negative 10-year duration for this.
Well, our larger clients wanted an idea that would be the least disruptive to their existing bond portfolio. They said, we just want a little of an insurance. We want to be able to sleep at night, not have to watch every employment report or every Fed meeting. And so we wanted to get as much bang for our buck. And having a negative 10-year duration is pretty significant. So you have you can get a lot of protection with a small amount of money. And they also wanted to keep their portfolio where it was. So a lot of clients have a portfolio that's maybe further out the yield curve, especially municipal bonds, because you get more income when you're out around the 10-year. And they really didn't know when the Fed was going to raise rates, if ever, at the time. And if you shorten the duration, go into these short duration funds, you might only be earning 0.5% yield, and they really wanted to avoid that. So they said, we want to stay out on the yield curve where you can still get income, but we don't like the price risk. So combining rise with their existing bond portfolio left them with most of their income while cutting their interest rate risk in half sometimes. So that's how we came up with that negative 10-year duration, because it coupled very, very well with their existing bond portfolios.
Okay. So when you're saying they use this as a combo, do you mean they're using a 10% into rise, or are they putting a little bit more sizable position?
That's a great question. On the calculator, you can really pinpoint exactly what percent of the portfolio you want to use in rise to see exactly what duration you're going to target. I shouldn't say exactly; it's an estimate. But my rough rule of thumb is if you allocate 15% of your bond portfolio to rise, you cut your interest rate risk or your duration almost in half. So that's kind of a good rule of thumb to use.
Okay. Yeah. And so you're thinking the Fed's probably going to raise rates this year in December. What do you think about next year? Do you think we're sort of going to continue on this just December hike track, or might we see a little more volatility from the Fed next year?
I would like to see them go slow. I'd like them to go every 3 or 6 months and get that Fed funds rate up to around 1 to 1.5. That would eliminate a lot of the excess leverage that hedge funds and other risky investments are using. I think that would be healthy for the financial markets. But they are really bad at actually following through on what they say they're going to do. So I think it's going to be a bumpy ride. I would expect volatility to continue. And it used to be that it made sense to take more risk to get more return. But with how volatile markets have been, it seems like it's better to give up a little bit of income and seek out strategies that provide a shock absorber or protection. In the case of Rise, we see that as buying collision insurance. So you want to have it before the event occurs. And next year could be really volatile. And so I would hope that people are looking at protection strategies as much as they're looking at maximizing return.
Definitely. You don't want to buy the insurance after your car is already banged up. It's a little late.
Exactly.
Now, is there anything on the horizon for SIT or for the for your ETF lineup, or is this kind of the main focus right now for you guys?
That's the main focus for the ETF lineup. We have other strategies that we've been launching that have more income. We're looking at some high yield strategies and some closed-end bond fund strategies. The danger sometimes with the closed-end bond fund strategy is when the Fed does raise rates, sometimes you'll see kind of a panic and people will sell their shares that in a way that's disorderly. But if you combine a closed-end bond fund strategy with the protection from Rise, you end up with a really good combination because some of those closed-end funds have a yield of 6%. And if you can protect yourself from the downside, it's a lot better way of investing than just, staying in a money market.
Yeah, definitely. So at the end of the day, you view Rise as sort of this hedging tool that a lot of investors can, apply to their portfolio that if they're a little worried about interest rate hikes in the future. Is that fair to say?
Definitely.
All right, great. Anything else you want to add about Rise or the SIT funds?
We are proud of the fact that last year we were voted the #1 mutual fund company by Barron's, and they look at 1, 3, and 5-year returns. So we're very proud of that, and that's the last thing I'd like to mention.
Yeah, sure. Well, hopefully you guys can keep up the streak this year and the following year as well. All right.
Yeah.
All right. Thanks, Bryce. It was. I think this was a great talk, and definitely appreciate you coming on.
Great. Thanks for having me.
Okay, everyone. Thanks for listening to the latest edition of the Dutram Report. That was Bryce Doty of SIT Investment Associates talking to us about their fund, SIT Rising Rate ETF, symbol RISE, and their website was risingrateetf.com. Hopefully you enjoyed today's talk, and if you want to hear more, make sure to go back to Zacks.com and look out for the next edition of the Dutram Report. Until next time, I'm Eric Dutram.